Welcome to This Explainer. Today we're mapping out a clear road trip to financial growth, and more importantly, figuring out how to avoid the common traps that completely derail even the smartest money out there. We're drawing our roadmap directly from some fantastic Forbes research that breaks down the most frequent investing mistakes and exactly how you can dodge them.
So, what is the actual cost of a simple investing mistake? Well, it's definitely not just a few pennies lost today. Look, when you're just getting started, building wealth is incredibly exciting. But because of the nature of compounding, early missteps can drastically, and I mean drastically, alter the trajectory of your returns over the long haul.
To make this incredibly actionable, we've organized these insights into a 4-phase masterclass. We'll cover what to do before you start investing, building your investment engine, dodging hype and fads, and finally, managing for the long term.
All right, phase one, before you start investing. We're laying a rock-solid foundation here. Your journey absolutely has to start with setting specific financial goals. Are you trying to build a retirement fund, scraping together a mortgage deposit, or maybe you're saving for your kids' university fees? Setting these goals is your GPS. Without a clear destination, even the fastest car is just going to get you lost. Your goal tells you exactly what your time frame should be, what kind of assets you should look at, and most importantly, how much risk you actually have the capacity to take on.
Now, before a single penny goes into the stock market, you need a rainy day fund. The recommendation here is building up around 3 to 6 months worth of your salary for unexpected expenses. When you're building this fund, you're going to face a trade-off. Fixed-term accounts offer higher interest, but they lock your money away. For emergencies, though, easy access is king. You might get a slightly lower interest rate, sure, but you have instant cash when the boiler explodes or the car breaks down. Next up, we have to talk about inflation, which is basically the invisible thief in your wallet. It's simply the rate at which prices rise over time. And ignoring it, well, that's a guaranteed way to lose money safely. Failing to factor inflation in before you invest is a massive mistake. Just think about the math for a second, assuming a 10% inflation rate. That 100 pounds you have in year one, by year two, you're going to need 110 pounds to buy the exact same groceries you would have bought a year earlier. Your original 100 pounds literally lost 10% of its purchasing power. The crucial takeaway here is that if the return you make on your investments is less than the rate of inflation, you aren't just standing still, you're actively going backward. The real value of your hard-earned assets is decreasing. Moving right along to phase two, building your investment engine. Let's look at the mechanics of a strong portfolio. The crucial point right out of the gate here is maximizing one very specific number, 20,000 pounds. In the UK, this is your current annual stocks and shares ISA allowance. And let me tell you, it acts as an absolute superpower for investors. It's basically a tax-free wrapper around your investments. If you use it, you get to keep your profits, your dividends, and your interest completely tax-free up to that limit every single year. Not making the most of this is literally leaving free money on the table. To keep that engine running efficiently, you need to avoid 3 major mechanical potholes. First, track your fees, whether they're from an online platform or a wealth manager, because compound costs will absolutely destroy compound interest. Second, diversify. If you put all your eggs in one basket, a single drop ruins breakfast, right? Spread your risk across bonds, shares, and cash. And finally, never skip independent research. Keep up with industry updates and seek professional advice to guide your strategy. Okay, phase 3, dodging hype and fads. This is all about navigating the psychological noise. We have all been tempted by that one asset everyone at a dinner party is bragging about. But jumping on short-lived bandwagons is a classic mistake. While the hype sounds super appealing in the moment, these fads fade incredibly fast. Successful investors don't chase fashions. They let the crowd chase trends, while they stick to their long-term map, always asking themselves if an asset actually fits their specific financial plans before buying it.
And that brings us to phase 4, managing for the long term. Let's talk ongoing portfolio maintenance.
Finding the Goldilocks frequency here is key. Reviewing your investments is essential, but as a general rule of thumb, checking them just once or twice a year is usually the sweet spot. Logging into your brokerage app every single day exposes you to the daily roller coaster of the market, which is a guaranteed recipe for panic selling. Normal fluctuations happen, guys. Monitoring over a longer time frame gives you a much more accurate picture so you can make rational rather than emotional adjustments. Finally, the most expensive mistake you can possibly make is wasting a failure. You are going to make bad investment decisions. That's just a guarantee. But instead of ignoring them, put them under a microscope. Acknowledge your wins, sure, but actively sit down and dissect why a strategy failed.
Understanding those missteps is the only way to really bulletproof your future decisions and ensure you don't repeat the same blunder twice. So I want you to take a hard look at your own roadmap today. Are your eggs all in one basket? Are you letting inflation quietly steal your purchasing power? Remember, the best time to fix a pothole isn't after you've already lost a tire. It's before you start the engine. So what is the one blind spot in your portfolio that's costing you right now?